Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll be discussing the bond market as the Fed prepares for its first rate cut this year. It's no secret that bonds have struggled in recent years due to inflation and high interest rates. Bonds are particularly sensitive to interest rates because when rates rise, existing bond prices fall. So when rates jumped in 2022 due to inflation and rapid Fed rate hikes, bond prices fell into a bear market. However, they then stabilized and rebounded somewhat in 2023. Today, many of the factors that have driven bond returns are improving. Over the next few minutes, we'll discuss some of the insights into the bond market and why it's important to maintain portfolio diversification in the months and years to come. First, this chart shows the performance of the different bond market sectors each year. Each column is a different year with the bond market sectors ordered from best performing at the top to the worst performing at the bottom. At the right, you can see that the Bloomberg U.S. Aggregate Bond Index is now flat on the year after struggling through April. That was because inflation was worse than expected for the first few months of the year, which pushed bond prices lower. However, there are now signs that inflation is improving. The latest Consumer Price Index report, for instance, showed that headline CPI was unchanged in May for the first time since July of 2022. Certain assets, such as housing prices, remain stubborn. But removing housing prices from core CPI results in a year-over-year inflation rate of just 1.9%. Of course, improving inflation does not mean that the prices will actually fall for the goods and services that we buy, but it is still positive for the markets because it means that we are slowly returning to a more, quote, normal environment, especially once the Fed begins cutting rates. For this reason, other parts of the fixed income market have also improved, including investment grade and high yield bonds. Next, this chart shows the federal funds rate and the Fed's rate cut projections. Their latest meeting resulted in no change to policy rates, but the committee did revise their forecast from 3 cuts this year to only 1. The remaining 2 cuts were simply pushed back to 2025. The projections are very much the result of worse than expected inflation from earlier this year. The markets seem to believe that there are still 2 rate cuts that could be possible, with the first one beginning in September or November. Regardless of whether it's 2 cuts or 1, the point is that the Fed is on track to begin reversing its policy moves over the last 2 years. If this happens, it could help to support bond prices, which benefit when rates are stable or falling. Of course, the Fed's projections are subject to change and a lot could happen between now and the end of the year. Still, this is a positive event for long-term investors since it means that portfolio diversification is more important now than ever. Historically, bonds have helped to balance out portfolios since they tend to move in the opposite direction of stocks. When the economy and the stock market stumble, for instance, interest rates tend to fall, which helps to boost bond prices. This pattern hasn't played out as much in recent years because the recent volatility has been the result of inflation, which hurts bond prices. This is why 2022 experienced such a dramatic bear market for bonds. If inflation is truly improving, at least at the macro level, and the Fed does cut rates, then this could be a tailwind for bonds. In addition, yields are far more attractive than they have been at any other time since the 2008 financial crisis. So, for both long-term investors and those seeking portfolio income, including retirees, it's more important than ever to stay diversified both across stocks and bonds. We've only scratched the surface on this important topic, and we hope you enjoy these insights. If you'd like to discuss any of this in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.